Today we are reviewing Realty Income. After my last video on Stag Industrial, I had someone comment about making a video on Realty Income and noticed there hasn't been an updated video on them in a while, so here we are. Realty Income share price is currently $64.11 with a dividend yield of 4.65%. That makes the monthly dividend 25 cents when rounded up. So the big question, is Realty Income still a buy? Hi, my name is John and this is Talk Finance. Before we continue, I would really appreciate it if you took a second to give the channel a like. It helps out the channel, and while you're at it, you might as well subscribe. As a thank you, here's a picture of a cute polar bear waving. What is Realty Income? Realty Income, also known as the Monthly Dividend Company, is a REIT. REIT stands for Real Estate Investment Trust, in case you didn't already know that. Its ticker symbol is O. That's right, just the letter O. They are an S&P 500 company with a mission to invest in people and places to deliver dependable monthly dividends that increase over time. By curating an extensive and highly diversified portfolio of single-unit, freestanding commercial properties under long-term net lease agreements, their business generates reliable revenue that supports the increasing monthly dividends and strategic growth initiatives. In other words, they buy commercial properties and lease them out to other companies and collect income on those properties. That cash flow that is collected is then paid out to the investors. Did I mention that Realty Income is a dividend aristocrat? That's right. That means that Realty Income has not only been paying out their dividends for at least 25 years straight, but they have been increasing it as well. There are only around 65 companies in the S&P 500 that can say they have been able to do this consistently. Keep in mind that the company was publicly listed in 1994 and has declared 630 consecutive common stock monthly dividends throughout its 50-year history and increased its dividend 118 times. The great thing about Realty Income is the type of properties they own. They are well diversified in the types of companies that they lease their properties to. The majority of their properties are leased to retail and industrial clients that have a service, non-discretionary, and or low price point components to their business. They believe these characteristics are important to successfully operate in a variety of economic environments and to compete effectively with e-commerce. Currently, this includes over 11,700 commercial properties under long-term net lease agreements, a 98.9% portfolio occupancy, and that is spread amongst 1,100 different clients in 79 separate industries. A few examples of properties they own and lease out clients to are CVS, 7-Eleven, grocery stores, gyms such as an LA Fitness or Lifetime, Chipotle, and other clients. There has always been talk on whether or not Realty Income can keep paying their dividend, let alone keep raising it consistently every year. Well, when looking at their 2022 second quarter balance sheet, they had nearly $3.3 billion of liquidity. The company also ended the quarter with modest leverage and strong coverage metrics, with net debt to annualized pro forma adjusted EBITDA of 5.2 times and a fixed charge coverage of 5.5 times. Realty Income does have debt, but it has a weighted average maturity of 7.6 years. Manageable near-term debt maturities and ample liquidity provide the company with the financial flexibility to tide over any issues and bank on growth scopes. Realty Income also has a credit rating of A- and an A3 rating from the S&P, which means they consider it a stable company. These ratings allow them to procure debt financing at great rates. But what really separates Realty Income from other similar REITs? Well, it's none other than management's unparalleled expertise and thoughtful capital allocation strategy. So what are other issues some people have raised about Realty Income? How about the fact that their tenants might not be able to pay rents in a recession, and the operating costs might skyrocket for Realty Income, or that people won't be returning to office, so owning that much corporate or commercial space might not have tenants to lease them? Well, first, I would say that Realty Income operates with a net lease tenant, so that means that the tenant is responsible for the majority of operating costs, including taxes, insurance, and maintenance. This considerably reduces the risk to the landlord. Like I said previously, Realty Income has well-known tenants. Other names you have probably heard of are Walgreens, Dollar General, and FedEx. When it comes to office space rental, well, Realty Income got rid of their office space a long time ago and made a spin-off company called Orion Office REIT, and they took over the office space portfolio. Another thing I do want to bring up is they do have a tenant called AMC. I'm sure a lot of people have heard of that. A lot of people are worried of whether or not they will stay in business. The great thing about Realty Income is they have spread out their portfolio in such a way that they make sure not one tenant owns a lot of their properties or leases a lot of their properties, to make sure they're well diversified. If you're looking for price appreciation in a REIT, well, it will happen eventually if they are consistently growing their portfolio. Since 1994, Realty Income has gone up 669%. That is some great growth for a REIT, and they have been paying dividends for almost all of that time. But if you look at the price growth for the past 5 years, it has only gone up by 18%. In this case now, with the new difference in price here, it's about 16.1%. And in the past year, as you can see, it's down 10.2%, which does prove the stability of the company since most of the market was down 15 to 30%. I really like dividends because of the power of compounding. And Realty Income is a great example of the power of compounding dividends. We do have to keep in mind that REITs are taxed as regular income, and if you don't care how they are taxed, then that should not be an issue for you. But if you are not near retirement, you might have different thoughts on that. I myself do own around 45 shares of Realty Income and haven't felt like it has been the right time to buy Realty Income at this price. This past year, Realty Income has been fluctuating between $55 and $75 a share, and I have purchased most of my shares near the $55 price, or even lower. Realty Income's current price to earnings ratio is 65, which is pretty high. I would say it should be closer to 35 to 45, but it is a popular company that is stable and consistent, and that still makes it a buy. Not at this price. If you want to make sure you have some price appreciation or growth, then I would feel more comfortable buying around that $55 mark. Remember, this is information I am providing to you. I am not telling you to buy, sell, or do anything with your shares of Realty Income. Always do your own research. Your investing strategy might change if you want to sell within the same year versus investors that want to hold the stock for 5 to 10 years or maybe never even sell. If you invest in dividends, the idea is that although you might not get as much growth as a value or growth stock, you will get the compounding effect that the dividends bring, and when reinvested will then purchase more shares, giving you even more dividends. Also, by having dividends paid out to you every month, quarter, or even year, you in theory won't have to sell any of your shares like you would with a growth stock. So if you invested a certain amount into dividend stocks and they paid you a yearly income of $50,000 a year, you would then get paid that amount instead of having to sell 4 to 5% of your portfolio every year and hope that the market is green. Also meaning you might not have to build such a large portfolio to retire early. I believe in the power of compounding and will own companies that pay a dividend, but always make sure to diversify. That way you can own some of your favorite companies and make sure you don't allocate too much of your portfolio to just one dividend stock. I like building a dividend portfolio that has both qualified and non-qualified dividends. Making sure I have a diversified portfolio is a great way to keep yourself covered in different situations. I also like to add a few growth stocks in there, and remember to chase quality companies and not the yields themselves. And remember, these are investments and not day trading plays. So if you hold on to shares that pay a dividend, you might get price growth, especially if you buy in a market when most people are selling, and get a great price on a company that you know has strong fundamentals. Also, a great thing is that if you are worried in 2023 about a possible recession or anything else where you might need that money, a great thing about REITs is that the price has stayed pretty stable, fluctuating up and down within the same range. And not only that, but if you're investing a good amount of money, you can just get the dividends every month in a lot of these REITs like Stag or Realty Incomes. If you enjoyed the video, please hit the like button and feel free to share the video. It might be informative for someone out there and it helps the channel. And while you're doing that, you might as well subscribe. See you next time.